Welcome students to today's Comprehensive Academic Explainer. Today we're going to take things nice and slow. We need to be methodical as we set the stage to truly master Chapter 12 of the tax legislation. Our focus here is the anatomy of anti-avoidance, specifically looking at how these intricate rules apply to owner-managed businesses. So I want you to settle in, take a deep breath, and prepare to absorb some really powerful and honestly very strict regulatory frameworks. Let's get started.
Here is our syllabus for today's session. We'll be moving chronologically through employment status, off-payroll working, and IR35, close companies, the highly detailed Section 455 rules, qualifying interest, and we'll wrap up with income shifting.
Module 1, Employment versus Self-Employment. Now, this distinction is absolutely crucial. It's the very bedrock of our masterclass today because, frankly, getting this wrong drives some incredibly severe tax consequences down the line.
Let's consider the 6 legal factors courts use to determine someone's employment status. You see, the engager and the worker, they don't just get to magically choose their status. It relies entirely on these tests. I really want you to take careful note of those first 2. First, mutuality of obligation, which basically means the employer is legally obliged to offer work and the worker is obliged to accept it. And second, control. Does the engager dictate what, when, and exactly how the work is done? Along with personal service, integration, financial risk, and the provision of equipment, these form the ultimate legal test.
As we methodically read through these different treatments, I want you to pay special attention to the expenses rule. For the self-employed, expenses just need to be wholly and exclusively for the trade. Easy enough, right? But for employees, notice the addition of a single punishing word, necessarily. Expenses must be wholly, exclusively, and necessarily incurred. It's a much higher bar. We also see fundamental differences in national insurance contributions, Class 4 versus Class 1, and in accounting basis. The self-employed can use the cash basis by default, whereas employees are always strictly on a receipts basis.
Moving on to Section 2, Intermediaries and IR35. Let's look at how these foundational concepts build into the use of personal service companies. This is a massive focus for HM Revenue and Customs when it comes to anti-avoidance. We really need to clearly draw the line here between who holds the responsibility for the actual tax deduction. On one side, we have the off-payroll working rules. If the end client is a medium or large private sector business, or literally any public sector body, that client must issue a status determination statement and deduct pay and NIC directly themselves. On the other side, we have standard IR35. If the client is just a small private sector company, OPW doesn't apply. Instead, the worker's own personal service company remains on the hook for calculating the deemed payment.
So let's walk step by step through exactly how that personal service company calculates the deemed payment under IR35. First, you start with the total amount invoiced to the client. From there, you deduct a flat 5% allowance for running costs. Next, you subtract any gross salary and employer's NIC that has already been paid out to the individual during the year. This leaves you with your total deemed salary plus employer's NIC. Finally, to find the actual taxable figure, you have to back out the employer's NIC fraction, which is 13.8 over 113.8. And that math brings you to your final deemed employment income.
Now consider this a crucial exam warning. Take notes here. If a prepackaged managed service company structure exists, meaning an MSC provider is involved in managing the company, these specific rules trump absolutely everything else. The MSC rules take absolute precedence over standard IR35 rules. No exceptions.
All right, Section 3, Closed Companies. Let's turn our academic focus now to the exact definition and the strict policing of corporate structures that fall under heavy anti-avoidance regulation. We need to grasp exactly who gets caught in this regulatory net. A closed company is explicitly defined as a UK resident company that is controlled by 5 or fewer participators or by any number of director participators. Well, you might be asking, who exactly is a participator? Good question. It is anyone who owns shares, holds loan capital, is entitled to call for distributions, or even just has a share in the company's income. It is a very broad net.
33.75%. I want to hit this exact number hard, so let it sink in. 33.75%. This is the punitive Section 455 corporation tax charge. If a closed company makes a loan to a participator and that loan remains outstanding at the end of the accounting period, this heavy tax charge applies right away.
As you can imagine, the consequences of being a closed company are pretty severe. Systematically, here's what we see. First, that Section 455 charge on loans we just talked about, it is due exactly 9 months and 1 day after the end of the accounting period. Mark that on your calendars. Second, any benefits provided to non-employee participators are taxed as distributions, and the cost is completely disallowed for corporation tax. Third, expenses paid for non-employee participators, also not deductible. And finally, if the business is a closed investment holding company, it gets hit with the flat 25% main rate of corporation tax, completely losing any access to the small profits rate.
Section 4. Detailed Section 455 rules. We are now diving deep into the microscopic anti-avoidance mechanics. These were specifically designed by lawmakers to stop owners from finding clever loopholes in the loan rules we just discussed. This right here brilliantly illustrates how HMRC prevents what we call bed and breakfasting loans. Let's look at the chronology of this trap, which is known as the 30-day rule. Let's say you repay £5,000 or more of an old loan just before that 9-month deadline. But then, within 30 days, you take out a new loan of £5,000 or more. Well, HMRC isn't fooled. They will treat your repayment as paying off the new loan, not the old one. Therefore, the Section 455 charge on the old loan will still bite you.
Furthermore, your subjective intent actually matters here. If a loan is at least £15,000, and at the exact time of repayment there was merely an intention to reborrow the money, the repayment is once again matched to the new loan. Also, if unspecified partial repayments are made, HMRC defaults to a very strict rule. They clear the earliest loans first.
Now, you absolutely must memorize these strict exceptions. Section 455 does not apply if the loan is just in the ordinary course of business, like, say, a bank lending money to a director. The other exception is for director employees, but notice how these criteria are linked together. All 3 conditions must apply. The loan must be £15,000 or less, the director must be a full-time worker, and they must own 5% or less of the company. If even one condition fails, the exception fails.
So, what happens if the loan is simply written off instead of being repaid? Take a moment. Think about the implications of just erasing that debt entirely. It sounds like an easy way out, doesn't it?
Well, the answer is a multi-layered tax disaster. Yes, sure, HMRC will eventually repay the Section 455 tax back to the company, but the write-off itself is a disallowed expense for corporation tax. On top of that, the participator is treated as having received a taxable distribution equal to the loan amount. And, to make matters worse, if they are also an employee, that write-off is simultaneously subject to Class 1 national insurance contributions. It is a complete headache.
Moving on to Section 5, Qualifying Interest. Let's shift our focus away from the penalties for a moment and look at a rare tax relief mechanism that's actually available to participators taking personal loans.
The crucial point to remember here is meeting the precise criteria. If a participator takes out a personal bank loan specifically to lend that money to their closed company or to buy shares in it, they can actually claim income tax relief on the interest paid. However, there's a catch. They must own at least 5% of the company or be a full-time member of management. And note that this relief isn't unlimited. It's subject to an income cap, which is the higher of $50,000 or 25% of their adjusted total income.
Section 6. Income Shifting. We have officially reached the final module of our syllabus today. Let's examine the traps surrounding extracting value and transferring assets.
You need to know that HMRC aggressively challenges any artificial manipulation of value. First up is dividend stripping. If you try to extract pre-capital gains tax value as dividends from artificial profits right before selling your shares, HMRC is going to challenge it. Second, transfers between connected persons. These are strictly enforced at market value for both corporation tax and capital gains tax to prevent value shifting. Finally, if shares are granted below market value, it falls squarely under employment-related securities, which triggers an immediate employment income charge on the discount.
Let's pause here on this visual summary. I strongly encourage you to take a mental screenshot of these vital figures for your exam preparation, from that heavy 33.75% Section 455 rate to the strict 9-month and 1-day deadline, all the way to the £5,000 and £15,000 anti-avoidance thresholds. Take your time with these. These numbers are the absolute structural pillars of Chapter 12.
As we conclude our masterclass today, I want to leave you with this one final thought. With loopholes closing at absolutely every turn, is the corporate structure a financial shield, or is it just a net for the unwary owner-manager? Consider the sheer weight of these anti-avoidance rules as you review your notes tonight. Thank you so much for joining me in this explainer.
Keep studying hard, and I will see you in our next lesson.